Welcome back to our next session of the Indonesia PEVC Summit. In this fireside chat, we're going to hear from KKR's Lucy Casey, a member of the private equity firm's next generation technology team, about how Southeast Asia is emerging as a significant part for the firm's Asia growth strategy. We also talked to Louis about the pressing issues in Southeast Asia tech, as well as the opportunities that KKR is seeing in the region, especially in Indonesia. I'm Ngọc Nguyễn, private equity correspondent for Digital Asia. Hello, Louis.
Hey, Ngọc, how are you?
I'm good. How are you?
Very well, very well. Thanks for having me.
Yes, I hope that you're being safe from the pandemic. KKR has recently increased the exposure to tech assets, especially in emerging markets of Asia. And through different vehicles and related entities in the past, you guys have invested in PropertyGuru, Gojek, and even e-commerce through a related entity. So now with the next-gen tech strategy for Asia, the first deal was in a Vietnamese company, GoTo, and recently you scored a deal in the growth area in the Philippines. We're just curious to know how Southeast Asia sits in the overall Asia mandate at KKR.
Sure. So maybe let me just try and break that down into a couple of key parts around how we're seeing the technology opportunity in Asia more broadly, but with a bit of a bend towards emerging Asia, and then we can kind of jump into the deals that we've recently done and how Southeast Asia fits into that. So I think the first point to note would be we're at a pretty important inflection point from a tech standpoint for growth equity in the region, we think, and really that's built on three key pillars from our perspective. The first pillar would be their macro drivers. Everyone knows them and talks about them in Southeast Asia in particular, whether it be population growth, GDP per capita expansion, consumption growth. I think they're all pretty well understood, but it does create a really compelling rising tide kind of macro story to invest behind. The second pillar, would be there's improving enabling infrastructure to technology adoption in the region. So that can be tech infrastructure like mobile payment, internet penetration, digital payments. It could be policy infrastructure like deregulation, or social infrastructure like education. And the third pillar, I think, would be talent. It all starts and ends with talent in the growth tech business. There's incredible entrepreneurs in the region, and that talent's getting better and better every day. And so, it's a combination of these factors that underpin the opportunity for tech in Asia, in the region. And our growth tech strategy is about really capturing that opportunity. And so, for the growth tech business, which I sit in, we provide high potential growth tech companies in Asia with value-added capital, and we think about making investments over a long period of time, much like we do, in our private equity businesses when we first came to the region. We're growth investors, so we look for proven product market fit, where capital is being sought to scale up a business, and that typically means we invest from Series B onwards. And as you mentioned, a couple of examples we can share from recent investments would be Viet in Vietnam, Grosar in the Philippines, and LiveSpace, which is an India kind of Southeast Asia deal. And we bring all the infrastructure that KKR has built over 45 years into the growth business. So that can be things like M&A capability, capital markets advice, internal operating expertise, talent networks, those kind of value-added levers that we think that we can help businesses with if they'd like it. And I think to your point, why are we going earlier? I think the answer to that question is pretty simple. We think there's going to be some really valuable businesses being built out of Asia, but Southeast Asia over the next decade or so. And I think we're likely to see technology leapfrogging in emerging markets versus developed markets, which creates new business models. And there's a few reasons for that, but really, businesses in Asia are digital first, and they're taking their customers from 0 to 1. And examples of that would be consumers are going from being completely unbanked to being neobanked with access to investment platforms, embedded insurance, and even crypto trading. Or almost going from pen and paper procurement to an all-encompassing B2B platform. So it's that kind of rapid technology adoption and lack of incrementality that exists in developed markets, which I think is going to drive some really interesting innovation that we're excited about. And I think it's the right time for us to go earlier as well. There's enough depth in Asian markets from a market maturity perspective. We're seeing increasing demand for value-added capital like ours. The exit environment's improving and the talent pool's getting deeper. And obviously, we've been in Southeast Asia now for, I think, since 2005, 17 years. So we've built some really deep relationships in the market with families and entrepreneurs. And so this new strategy is all about supporting them, even earlier in their life cycle, but for a long period of time.
Mm-hmm. So some of the portfolios and the most recent ones, they seem to, sit in the area of serving SMEs across the region. So besides serving SMEs, what are the key themes for KKR in Southeast Asia that you are looking at?
Sure. So look, let me, I guess, firstly, how we think about themes and our funnel, just to set the context. So we have thematic preferences that we actively track and we lean towards, but I wouldn't say it's a hard rule. I think things are moving so quickly in Southeast Asia that we try and kind of have a thematic disposition, but also retest our hypothesis all the time because oftentimes we're very wrong, and so we think that's a healthy dynamic. So for the thematic areas we're focused on, as you just mentioned, other than the SME enablement's a key one, we've invested behind that, and for reasons we've discussed before. There's a couple of others which I'd probably highlight. One would be, I call it enterprise infrastructure enablers. So these tend to be B2B vertical software applications. So these effectively essential non-core services to businesses that enable front office functions or revenue generating areas of the business. So these could be things like foreign exchange, KYC, compliance, cybersecurity, human capital management, things of that nature. And I think for us, this kind of theme is a bit of a double down on the rising number of startups in Southeast Asia. They tend to be early adopters of these vertical applications because they need them to support rapid scaling. And we also think that we'll see a number of businesses continue to move their headquarters into Singapore and expand throughout Southeast Asia, which is also an interesting dynamic. These businesses tend to be attacking regional or global market opportunities. They're not constrained by local countries, which is a bit of a watch out in this market. And they're just solving pretty large pain points for businesses. And I think there's also, an interesting regional dynamic to some of these vertical applications whereby there's a soft moat around them, which kind of defends against some of the developed market equivalents coming into this market. Actually, we think that they'll be regional first businesses, which we like. The other couple I would probably mention would be fintech and financial services. Obviously, that's a pretty broad space that people talk about a lot. But if I was to name a couple of subsegments, probably B2B and B2C payments, consumer financial, inclusion and credit, wealth management, and insurance. And the things that we look for there are businesses that tend to have some kind of recurring nature to their revenue. So for insurance, it would be insurance premium, or wealth management would be assets under management, relatively low churn, a high recurring revenue stream. And then the final theme for us, which is a bit of a catch-all, but we've got certain subsectors again, would be the time and money of the Southeast Asia consumer. We're looking for subcategories where there's some kind of network effect that kind of creates a lock-in with consumers. So one of them would be digital entertainment, specifically gaming would be one, but we're pretty wary of taking single title risk in gaming. So we're looking for more platform assets in that subsector, and then neo-banking would be another.
Mm-hmm. Within fintech, so is a financial related sector. So there might be some kind of legal issue in that. As we also look at China, the government has obviously issued some kind of scrutiny casted over their own players. Is that a thing in Southeast Asia? Do you have any kind of concern about the legal play and how the startups involved in the legal framework?
Yeah, look, it's a good question. I think regulation is always something that you have to be pretty wary of, and it's obviously a fluid situation, what's going on, particularly at the moment. So I think, it's always, when we look at these kind of businesses, regulation and regulatory dynamics are always on the risk register to understand. And I think we're pretty early in kind of reg in general, particularly in fintech in this space. And so we are looking to other developed markets to see how they are evolving over time and what we can infer from that. But look, I think it's something for sure that we have to be wary of, but it's also, some of the dynamics you talk about are still relatively early. So I'd say it's a watching brief.
Mm-hmm. In Southeast Asia, Indonesia is the largest economy here, and it has generated a lot of opportunities for VC and PE firms alike. Within the country, the market has a lot of investment flowed into e-commerce or logistic or ride-hailing. What are the new opportunities that the KKR is seeing emerge out of Indonesia?
Yeah, it's a great question. So look, there's plenty. Obviously, we invested in GoTo a number of years ago now. We've certainly been looking for other opportunities in Indonesia. We haven't managed to do one yet, although we've come pretty close, but we're looking to add to our Indonesia portfolio in 2022. I would say, look, other than the kind of large macro sectors like e-commerce and like logistics, there are a couple of early emerging areas that we're looking at. And one would be ag tech. And a company that comes to mind is eFishery as an example. It just strikes me as such a great story in business that's creating a lot of value for its customers, being farmers, and it looks really promising on a lot of different metrics we focus on at KKR. So, the business's place in the kind of market structure and the profit pool that they're trying to, capture, which are pretty important vectors, obviously. So, they're increasing yield and revenue for farmers, which creates a huge amount of economic value in regard to that profit pool that I just mentioned. They're matching supply and demand and mitigating catchment loss. They're controlling feed and go to market. So there's kind of lots of different ways they play in the value chain, which makes them difficult to compete with or dislodge. And obviously, it's a really large market as well, with relatively low levels of technology penetration. And so that space is something that we quite like. So looking there. The other one, which I'd probably mention again earlier, would be what I'd broadly define as the labour market. And that would include things like job classifieds, employment training, human capital management, anything that helps create more participation, skill development and wage growth for human capital. And this is a space that I've looked at in the past in more developed markets, but have seen less activity in Southeast Asia historically, but it just presents as something really interesting. There's a huge market of blue-collar workers in Indonesia that we can help develop, skills improvement, place into better jobs that pay better wages, drive labour efficiency, and potentially, as it occurs to us, create a platform to serve those people with financial services like consumer credit, or banking, and build telemetry around their ability to service credit, repay loans, make collections, understand fraud risk, things like that. So that would be the other. And then the other one, which is a pretty well, I guess, a well understood thematic that many people are focused on, is just this movement from getting the unbanked Indonesian consumer to the banked Indonesian consumer. The way, we've got probably a little more nuanced perspective on that. I think we want to see truly unbanked consumers become banked, whereas I think at the moment we're probably seeing underbanked consumers become overbanked, where they've got 3 to 5 different bank accounts and utilising them differently to get better transfer fees and other bits and pieces. So we're looking to try and look for businesses that can crack that problem. And our hypothesis is that it's more likely the business that really cracks that will attack it from a different angle by serving, a service or technology that's somewhat adjacent to financial services and building the trust of the consumer, building the telemetry around the consumer, and then enabling financial services through that. Then that could be perhaps, the job platforms that I just mentioned previously. So there are a couple that we're looking at.
And one of the major developments in Indonesia is that tech startups are snapping up bank assets, to have a broader access to financial offering. So how do you see the picture, going forward between the banks and and the tech players within Indonesia, and how does that, kind of spread the effects into other markets in the region?
Yeah, so look, I think it's still relatively early, but obviously, as you've seen the share prices of some of these listed banks, people are kind of, almost the investors and are showing how excited they are about this opportunity, particularly with some of the partnerships that are going on with these technology platforms. I think the thing that's pretty compelling is the telemetry that you can build around the consumer. And for ride-hailing platforms, whether that person is actually going to work or not is obviously a incredibly important metric as to whether you can provide that consumer credit. So I do think that they're building a pretty interesting, data insight, which gives them a differentiated ability to underwrite credit. And so the way we would think about it is, what other ways, what businesses have a true data advantage with their customers, such that they can infer the ability to sell financial services, but also underwrite financial services, and also kind of make collections, etc., understand fraud risk. Those kind of things really make a difference to the unit economics in a financial services business where you're writing credit. And so, look, it's going to be a really interesting space, right? I think they're obviously raising a lot of capital. They're run by great people that understand the financial services landscape, etc. And so, it's an exciting space to watch.
Right. So you explain why KKR is going into the earlier stage. Meanwhile, some other global hedge fund and private equity funds or just asset managers, they also some have expressed the intention to pull back from investing in the much later stage or the pre-IPO stage. So as they move to the higher growth and earlier stage, is that kind of competition for you guys, like more stiff competition? And on the other side, as they move back from the pre-IPO stage, does that kind of generate more opportunities for you to penetrate?
Yeah, look, I think it depends on the stage and maturity of the business. So, we at Series B, we see the crossovers a fair bit as competition, and they're great operators, to be honest. They offer a product that is very fast, very nimble, low governance, etc., and it is getting a lot of traction. But as you mentioned, they're pulling out of the later stage deals, which we quite like still, right? We look to support businesses for a long period of time. We are value-added investors. We tend to be a little more hands-on and try and be helpful. And we're going to be interesting for certain founders that like that kind of dynamic, like a private equity and operators mindset, like to be the first call if they're facing a problem. And that works for some businesses and it doesn't work for others. And so I think we'll continue to see that dynamic over time. Obviously, the markets are super volatile at the moment, and I think some of the pullback you just mentioned is a reflection of that, right? With LPs putting pressure on some of those businesses to think about where they have a right to play in their product and the risk they want to underwrite. But we're early days into this kind of cycle, so again, it'll be interesting to see what happens. Certainly this year, right? I think it's still only February. Last year was super active. It's still the start of this kind of market in the calendar year, and so it'll be interesting to see just how active they are as deal velocity increases through the year.
Yeah. Well, one of the opinions, one of the views was that those guys are pulling back from investing into the later stage because the performance of the companies after they go public has been not quite strong. Yeah. So do you think is that kind of an effect of investing in down rounds for growth investors in these tech companies?
Look, no, I think what we're seeing is just when you mentioned that the public market volatility, I mean, I think that's just a reflection of just general risk sentiment reweighting, right? Given inflation expectations. And so we're seeing a pretty fundamental shift from a cycle standpoint, which, quite frankly, the crossovers have, I suppose, gotten a little caught from a timing perspective, which is they had set out a strategy that executed very well on that strategy, where they took a very long-term view about buying. In fact, the way I think about it is they are buying the private market index of technology, right? And I think public markets are re-rating risk, and that'll eventually flow through to private markets, and that may create down rounds. I mean, that's normal. I think there's a funny dynamic in private markets whereby it's rare to do a down round, whereas it's hard to find a public markets business that hasn't had the share price trade-off, right? That is a very private market nuanced dynamic, which I think isn't really reflective of the true underlying performance that businesses go through, the ups and downs of being a startup and scaling. And so I think that's the dynamic that's happening at the moment, in short.
But if we look at some recent tech stock prices movement, then they tumble quite steeply. Like even for Grab or like Bukalapak or even C Group, they lost a lot in value. So in addition to the overall public market volatility, then what seemed to be have a great impact on prices?
Yeah, I think
particularly for tech assets.
Yeah, look, I think it's the way. I mean, I simply think about it is, investors are. I mean, everyone I think is aware of this. The market is telling us what they think about the price of risk and inflation expectations. So I think everyone kind of woke up from the 2021 liquidity party and realized that things were perhaps a little overdone, right? And I think as a catalyst with the Fed changing their view on what interest rate cycles will do, et cetera, and expectations, all these businesses are running business models whereby cash and profitability is still, a long-term thing, where these businesses are going for scale, and they're not going to be cash flow positive for a number of years. So when you discount that cash flow back to today, with a higher risk premium, it just impacts the valuation of the business. But I do think, generally speaking, I mean, the catalyst was inflation expectations, but I do think that catalyst actually just created more of a general focus on where valuations are from a risk settlement standpoint. I mean, it's above and beyond, investors going into spreadsheets and changing the discounted cash flow and the metrics they're using to use to value businesses. They're actually thinking about whether those numbers make sense. Markets are not purely efficient. And that was just a catalyst for a general risk reweighting that occurred that you're seeing at the moment. I mean, multiples are down 50%. And clearly with the macro volatility with the conflict we're seeing at the moment in Ukraine and Russia, that's also adding to greater uncertainty with that investors don't like.
As we are saying about the political tension in Europe, well, the private market, why we is generally not insulated from the public market movements, but to some certain extent it has impacted. Yeah. So in your views, to what extent the invasion of Russia by Russia of Ukraine impact the private markets here, especially in the tech sector?
Yeah, look, I would separate the two. So, from our perspective, the first event is the inflation expectations, right? That created the general tech re-rating that happened at the back end of last year and the start of this year, and that was more to do with kind of fundamentals around where valuations are, and that created most of the re-rating, right? And then I think if you rebase, where those stocks are now, and then how they've traded over the last couple of weeks, given the increase in uncertainty, I think it's difficult to assess what that means from a fundamental standpoint. I think there's just more of an overhang of uncertainty that markets don't like. And so it's just adding to that uncertainty and increasing that risk premium that we're talking about. I don't think that fundamentally, but for long tail events, given the conflict, which is hard to forecast, it should materially change the market unless we see some very large or very bad outcome, I suppose, with the Ukrainian and Russian conflict dynamic that creates contagion into other markets more broadly.
Yes. And with some of the global growth investors, in we have a record year with more unicorns, and then the overall valuation in Southeast Asia. Do you think that tech assets here are kind of overly inflated? And especially there is a lot of discussion how assets are so expensive especially in Indonesia. Do you see that the valuation for private companies correcting at the moment or going forward?
Yeah, look, I think that the valuations of businesses in Southeast Asia probably reflect, the how excited investors are about the region and some of those macro drivers that I mentioned. So there's a lot of capital flying into the market at the moment in Southeast Asia, chasing that growth story and chasing a lot of these businesses that are emerging. So the back end of last year, it's an asset by asset story. Some assets are very expensive. Some assets seem fairly priced. I think you have to be relatively nuanced around, how you think about, private market pricing. But I would say on average, we certainly saw an expansion in multiples, right? I mean, it's hard to probably argue the counter to that point, particularly at the back end of last year. I mean, valuations were up across the board. But as I mentioned, I think people are kind of coming back to 2022, just given the tech re-rating, etc. And I think, valuations will come down a little bit. We're already starting to see that a little bit. I think it'll be somewhat in private markets cushioned by that weight of capital dynamic that I mentioned before, right? And just given how much people want to deploy here and how excited they are about the story. But at the end of the day, there has to be some kind of convergence to public market valuations and private market valuations. Either public markets recover or private market valuations come down. There's just a lag that usually occurs between the two. I think we're still a little early as to see, where that really settles at the moment, but I would expect it to come off a little bit.
Mm. And with the valuation coming down a bit, and related to the earlier question, did you think that we would expect to see more down rounds?
Yeah, look, I think we may, for some businesses. If that's the case, I mean, look, some businesses probably pushed valuations pretty hard at the back end of last year. Obviously, they didn't raise capital, but there was less activity in 2020 coming off the back of COVID. So 2021 was a bit of a catch-up year. So there was a lot of capital in the market, a lot of people wanting to raise capital and very frothy, a very frothy liquidity environment. And then, so that's kind of created a high bar in valuations. And then you've seen this kind of big macro correction, right? So that equation for some assets is going to put pressure on that down round dynamic. But again, it's asset specific.
Yes. Well, I have one more question on the exit landscape in Southeast Asia. So we are seeing more IPOs and SPACs, more companies pursuing SPACs, or even direct listing in local exchange, either local exchange or in the US or somewhere else. Meanwhile, because of the market volatility, so they might have to hold on a bit and wait for better timing. And some views are also saying that actually M&A and trade sale or selling to a strategic is a better deal, because strategic tends to pay higher. So how do you see exits shaping up in Southeast Asia when we see more IPOs or M&A is still prevailing?
Yeah, so look, I think it's no great secret to the market that 2021 was a bit of a watershed year for exits in tech. So by my count, I think when I looked at this prior to 2021, there was only a handful of businesses that really had meaningful exits where capital was returned in a meaningful way back to shareholders. And so obviously we saw a number of businesses go public. There was a lot of SPAC activity. And obviously a few local IPOs. So that gives us a lot of excitement about the maturity of the exit market in Southeast Asia. So I think if you draw a trend line and just ignore the macro volatility that's going on at the moment, because I think we haven't found a settled level there yet, I would say we are really confident about the local exit market through cycle. There's a lot of interest in the Southeast Asian story from international investors and institutional investors, and we've seen this in our own portfolio obviously with PropertyGuru that's going public via SPAC shortly. So I think that the overarching story is a positive one. We will see more exits. We will see probably less SPAC activity, right, from last year, but more fundamentally, rather, more local IPOs. But again, obviously, this is a tough market at the moment to seek public liquidity until the market kind of balances and finds its kind of new rhythm. And around that kind of risk sentiment dynamic we spoke about, I think it'll be challenging, but I think that'll occur this year. And we'll continue to see more exits once that happens, the back end of this year and next year and so on.
Mm-hmm. In terms of the returns, so not limited to tech assets in general, a lot of the LPs and GPs have opined that return in Southeast Asia is still relatively lower than other parts of Asia, like China or India. Yeah, did you see anything different, or do you agree with that?
Yeah, look, I can only talk to tech. That's where I spend my time. But I think the short answer is yes, absolutely. We do see something different. I mean, I think the market activity, the amount of capital flowing into the market, tells you that investors are excited about this space, about this region. They're coming and deploying capital, expecting an attractive return. We're similarly very excited about the opportunity in Southeast Asia for all those reasons that I mentioned earlier in the call. And so, look, I think things are looking really good. There's a lot of green shoots. I would say though that we're early, right? I think benchmarking returns at the moment in Southeast Asia, particularly in tech, is tricky because we're just so early, and that's one of the things that makes us really excited about investing in this region behind some of these growth technology companies. I think perhaps some of the dynamics that you mentioned, or the wariness from LPs come from a few dynamics that are specific to Southeast Asia that might be worth just mentioning. I think some of the challenges that are faced in Southeast Asia that perhaps aren't faced in markets like China is, I think fundamentally there's just a much more nuanced monetization challenge in Southeast Asia, just given the kind of cap on GDP per capita levels, cheaper labour that could potentially catch investors out. I think you want to see profitable growth at scale where customers are actually paying you for your product, right? And I think last year, back to that multiples and valuation question, I think for some businesses we're not seeing that, right? Where they're kind of pre-monetization, but they're growing quickly, and so where the rubber hits the road is when they actually start asking customers to pay. And I think the other dynamic, which is a challenge, is Southeast Asia is just complicated from a country dynamic. So I think we'd really encourage models to think regionally or globally day one, so that they don't kind of face this I guess market expansion friction that inevitably occurs, particularly in some sectors where there might be TAM limitations. So that's the other dynamic that may be playing into some of that commentary you mentioned.
Yes, great. Well, thanks a lot, Lewis, for your insights and your sharing. I believe that our audience have got a lot of knowledge, new knowledge and insights about their investment in Southeast Asia. And I do hope to see more investment by KKR in this region and even the future subsequent exits.
Pleasure. Thanks so much for having me.
Thank you, Lewis.
Yeah, bye-bye.